Money, we all use it, we all rely on it, and yet, very few of us truly understand it. Have you ever wondered why banks never seem to run out of money? How is it that, even during financial crises, banks continue lending, continue operating, and continue creating the illusion of infinite wealth? Today, we're peeling back the curtain on the world of modern banking. This isn't about getting rich quick. It's about understanding the engine that drives economies, governments, and even our daily lives. At first glance, it seems impossible. You deposit your hard-earned money into a bank account, but that bank doesn't just sit on your cash in a vault. They lend most of it out, invest it, and somehow, still always have money available for withdrawals. If you've ever worried about whether your bank can actually pay you back, the truth might surprise you. To understand this, we need to start with one concept: fractional reserve banking. It sounds complex, but it's actually quite simple. Banks are required by law to keep only a fraction of your deposits in reserve. Imagine you deposit $1,000. A bank might be required to keep only $100 in reserve. The remaining $900 can be loaned to someone else. That person then spends it, and it gets deposited into another bank. That bank then keeps a fraction in reserve and lends the rest. The process repeats over and over. This is how money multiplies in the economy. But here's the key. Banks don't need all your money to exist at once. They operate on trust, regulations, and the careful balance of deposits versus loans. This is why, even if millions of people withdrew their money at once, most banks wouldn't collapse immediately. They can borrow from other banks, the central bank, or access emergency liquidity. Now, let's take it one step further. Most people assume banks are limited by physical cash, but in reality, money today is mostly digital. Only a tiny fraction exists as paper bills and coins. The rest is a series of digital entries, numbers on a screen. When a bank gives out a loan, they don't hand out cash from their vault. They create new money electronically. Yes, you heard that right. Modern banks literally create money every time they issue a loan. This is how economies expand. This is why banks never truly run out of money. They create it when needed, within regulatory limits. But, of course, this system isn't without risk. When too much money is created too quickly, it can lead to inflation. When banks lend recklessly, or borrowers default, it can lead to crises. Yet, the system has built-in safeguards, capital requirements, central bank oversight, and the ability to borrow in emergencies. Central banks act as the ultimate safety net. They can inject liquidity, adjust interest rates, and stabilize the financial system. This is why, during major crises like 2008, governments and central banks stepped in to prevent a collapse. Without this backstop, the confidence in banks and in money itself would evaporate overnight. To understand why banks never run out of money, you need to realize that the banking system isn't about storing cash. It's about managing trust, liquidity, and credit. It's a carefully choreographed dance between borrowers, depositors, and regulators. And there's another layer most people miss: the role of interest and profits. Banks make money primarily by charging interest on loans, not by keeping deposits. The more they lend, the more money they can earn, creating an incentive to expand credit. That's why banks are constantly innovating with lending products, credit lines, and investment opportunities. Let's break this down with a simple example. Say a bank lends $100,000 to a business to expand operations. The business pays back with interest. That interest is profit for the bank. At the same time, the loan itself created new money in the system, allowing someone else to deposit, spend, and invest. This continuous cycle of lending, interest, and reinvestment is what keeps banks alive. And here's the kicker. Even if you and your neighbors withdrew every dollar at the same time, the bank could still survive temporarily through central bank facilities and interbank loans. The money isn't disappearing, it's being moved, borrowed, and created digitally. So, the next time someone panics about a bank running out of money, remember this: banks don't hold all your money in cash. They rely on the trust in the system, regulation, and the magic of credit creation. Without that trust, the entire economy could grind to a halt. But as long as trust remains, banks will continue to operate, lend, and grow, even in times of uncertainty. Now, this is just the beginning. Understanding fractional reserve banking and digital money is fascinating, but there's an even deeper secret that most people never hear about: how central banks, government policies, and financial markets intertwine to create a system where money really seems infinite. So, how does this infinite money illusion really work in practice? To answer that, we need to look at the relationship between commercial banks and central banks. Central banks, like the Federal Reserve in the US, the Bank of England, or the Reserve Bank of Australia, don't just print money and hand it out. They manage monetary policy to control inflation, interest rates, and liquidity. When a commercial bank needs extra cash to meet withdrawal demands or fund lending, the central bank steps in as the lender of last resort. Think of it as a safety net. The central bank ensures the banking system never truly runs out of money, even if confidence falters. This is why, during the 2008 financial crisis, trillions of dollars were injected into the system to stabilize banks and prevent mass collapses. But here's the fascinating part. Most of the money you see circulating your deposits, loans, credit lines, was never physically printed. It exists digitally, as entries in a ledger. When banks create a loan, new money is born. And when loans are repaid, that money disappears. This constant creation and destruction of money is what fuels economic activity. It's like a river that flows continuously, sometimes fast, sometimes slow, but never completely dries up. Even in recessions, the system has mechanisms to keep the flow moving. This is why the banking system is often described as both fragile and remarkably resilient at the same time. Now, you might be thinking, if banks can just create money, why doesn't everyone do it? Why isn't there unlimited wealth for everyone? The answer lies in regulations, risk, and economics. Banks must maintain capital ratios, manage risk, and ensure they can cover potential losses. Excessive lending can lead to inflation, asset bubbles, or defaults, which could trigger a collapse. Central banks monitor these activities closely and adjust interest rates or liquidity to keep the system balanced. It's a high-wire act. Create too little money, the economy stagnates. Create too much, and prices spiral out of control. To make this more concrete, let's consider the 2008 housing crisis. Banks were lending aggressively, creating money through mortgages. When borrowers started defaulting, the illusion of infinite money faltered. Suddenly, trust eroded, and banks needed central bank support to survive. The lesson? Banks can create money, but trust and risk management are the true limits. Another example comes from COVID-19. Governments and central banks around the world injected trillions in stimulus packages. Commercial banks could lend more freely because they knew liquidity was guaranteed. The result? Economies avoided total collapse, and people continued to have access to money despite massive disruptions. Understanding this system changes how you see everyday banking. Your deposits aren't just money stored in a vault, they're part of a larger ecosystem, working to fuel loans, business investments, mortgages, and even government spending. Your bank account is a node in a vast web of financial trust, where digital money flows and grows every day. And there's one more subtle, powerful effect: interest. Banks lend money at interest rates higher than what they pay depositors. That interest doesn't just keep banks profitable, it funds the central mechanisms of finance. It's how the financial system incentivizes growth while maintaining stability. Without this, the whole structure would collapse under its own weight. So, next time you hear the panic about a bank running out of money, remember this: banks operate on trust, regulation, digital creation, and liquidity mechanisms. They don't hold all cash physically, but they have a system in place to keep money moving, even in the worst crises. It's not magic, it's finance. But it can feel magical when you realize how efficiently trillions of dollars are created, lent, and recycled every single day, all without a single dollar leaving the digital ledger. Banks truly are the quiet engines of modern economies, silently ensuring money never stops flowing. If you found this deep dive into the hidden mechanics of money fascinating, don't just stop here. Hit that subscribe button, because we're uncovering the secrets that shape our economy, investments, and your everyday life. Drop a comment below and tell us, did this change the way you think about your bank? And don't forget to share this video with someone who's still worried about the banks running out of money. After all, knowledge is the real currency in today's world.